He's known for his calm conviction and contrarian calls, the man behind one of India's most admired value investing houses. Parag Financial Advisory Services. And let's welcome on board Rajeev Thakkar, CIO and Director at PPFAS, as we call it. He's built a reputation for staying patient when markets get euphoric and bold when others get fearful. Rajeev, great to have you today on ET Now. How do you keep calm in these markets?
Stay away from the noise largely. So when there's nothing to do, do nothing. That's what we try and do. And office is also calm, not too many stock screens around and things like that. And most of the time is spent reading, understanding what is happening in the business world rather than in the day-to-day ups and downs of the financial markets.
So if I look at the index, it's done actually just nothing in the last 1 year, right? Has that been the strategy, or have you done nothing in your funds?
It may seem like we have done nothing, but that is not the case. So while people think that we have been largely in cash in the region of 20 to 25% and we have not been doing much, we have actually added stocks. We have sold some of them. On a net basis, the result may seem like we have done nothing, but there have been activities that we have been doing. So on both sides, we have been active, buying as well as selling.
But the fact that you've increased your cash levels, is it more of a valuation call, or is it more sort of sense of caution because of what's happening around the world?
It's nothing to do with the global events whatsoever. So just for context, when global environment was in the news, March of 2020, we ran down cash from 13% to 3%. So we deployed 10% in a single month. So it's nothing to do with global events, not to do with Russia-Ukraine war or tariff being on or off, or India-Pakistan tensions, or nothing around that. It's pure and simple valuations. There are pockets which are looking attractive where we have invested, but we cannot invest beyond a point in the same set of companies or in select sectors. So that is resulting in some cash in the portfolio.
Got it. So you've come in and you've bought some stake in companies in the auto sector, and I don't want to name those companies because maybe there is a conflict there. But talk to us about the thesis at play there, because auto has run up quite substantially. And this is, of course, on the back of consumer discretionary likely to do well. And we know you to take long-term calls, right? So talk to us about maybe the next 2 to 3 years that you're seeing. Is there an unwind expected in auto in a big fashion? And give us your thought process behind that call.
So auto is a space which I think is going through a lot of transition elements in a sense. And we had been very, very cautious in this space. We had one four-wheeler company. We had trimmed other exposures largely. So that was all there was there. The transitions that I am referring to, at one end, while unit sale numbers were somewhat subdued, but that transition from small hatchbacks and sedans to the large form factor SUVs was one big trend. And the bigger question was about the powertrains. After petrol and diesel, what? So at one end, there has been this whole ethanol blending thing, CNG as a powertrain, diesel, will it be there, not be there in the CAFE 2 norms and onwards? What will happen to electrification? So all these were questions, and we had caution on account of the entry of Chinese players into India. So you had BYD coming in, you had MG coming in through JVs. After a while, one thing is clear, we will not give a free rein to the foreign players.
Correct.
So that is very, very clear to me at least. The second thing was a lot of the domestic players actually upped the game in terms of the product launches, etc. That gave confidence, and the GST cuts were a lucky happening after we bought the stock, which is reviving the sales and things like that.
But sir, two key risks here, right? And they've always been prevalent, especially in sectors like auto. Your return ratios are quite compressed, traditionally always have been. It's sort of commoditized with the global marketplace and technology in the global marketplace. And that technology, at least in the global marketplace currently, in terms of the delta versus India, is probably the largest that we've ever seen it in the last 2-3 generations. So how should one hedge for some of those risks, and how do you view those? Try and give us that context versus what you've invested in. How do you view those risks versus the investment you've made?
So, there are various levers for auto companies to improve efficiencies. So, two-wheeler companies actually have been at the forefront of that, where they farm out a lot of the work to ancillaries. They focus more on the branding, product design, and after sales and things like that. So, that of course is a lever which can be played even by four-wheeler companies. Return ratios haven't been that bad in the Indian context, at least in these spaces where we invest in. Technology, yes, it's a risk transition and things like that. But if you look at the new powertrain EV, the biggest technology factor there is the battery pack and the motors, etc. Rest of the car, we know how to build good quality cars. So the suspension, the seating, the windshields, and rest of the body, we are more or less there. And some of the product launches have been quite good. So if you look at the vehicles on the road, they have been quite of acceptable quality.
Oh yeah, absolutely. Other than autos, where is it that there is bottom-up value?
So there are very few sectors in India which are now still under licensing, and where their entry barriers are reasonably high. Banking is one of the spaces. Near term, maybe there could be margin pressures because the interest rates on advances reset quicker than the interest rates on the deposit book. But that is one space which hasn't done that well. When people go out and buy more homes, when people go out and buy more cars, the financing will come from the formal sector. A lot of attention in the last few years has been on the NBFC space. But I think one should not ignore the banking space. I think that is one space which is looking reasonably attractive.
But again, when it comes to banks, there is such fierce competition. The market looks at private banks, PSBs, smaller PSBs, all in every bank with a very different lens. Where within the entire umbrella of banks do you find preference, or do you prefer?
So when most individuals look for a bank, when they have to select a bank to open their account, they look for a few things. You need an adequate branch network, ATM network. You need a good tech stack in terms of the net banking, the app. You want the entire ecosystem. So you may want to open a securities brokerage account with them, or you may want a suite of products from them, let's say mutual funds, life insurance, general insurance.
All of it in
all
one.
Of it in one. So there are largely 4 large private sector banks and 1 public sector bank which make the cut. Remaining are there in the tier 2, but they are still not right up there. So this is the space where we track for opportunities.
And give us this thought process behind the SIP flows being so large, depriving the banking system of deposits. Is that at all a risk? I know you have a very unique view on this one.
Sure. So, 2 things here. One is bank lending cannot be happening, at least to the corporate sector, unless the companies are well capitalized. So one of the ratios that people look at is debt equity ratio. Without equity issuance, banks will not be able to lend to the corporate sector. The other thing is that money does not leave the banking system. Money can come in or go out of the banking system largely on account of central bank actions or whether government is spending money or not spending money. When an individual gives a SIP inflow to a mutual fund, that money goes from the individual's account to the mutual fund's bank account. When the mutual fund buys stock, the money goes out of the mutual fund's bank account to someone else's bank account. So actually this is a misnomer in my view. I don't think money leaves the banking system. There can be disintermediation of banks if people put money in bond funds and bond funds start buying corporate bonds. So to that extent, banks' business could go down. But that hasn't really taken off in India. Largely our market is restricted to AAA corporate bonds. And that it's been that way for many, many years now. So I don't think banks need to worry too much.
But you know, Rajiv, the question about retail participation, and I often wonder whether the retail players will continue to pour in money into equities the way they are, because where we are today is because of retail participation. Because, you know, like we were talking about, the massive chunk of demat account addition has happened only pre-COVID. So that's the sect of people which have not seen a deep correction ever in their investment history. Will they stay put and convinced about equity markets is the question.
That's an interesting word you use, put.
Yeah.
Because calls and puts are the all that people seem to be doing these days. So more demat accounts being opened is one part, but a lot of activities happening in the F&O space. So last year's data, 1.7 lakh crores worth of IPOs, which whether offer for sale, fresh issuance, it went towards investment activity. But 1.06 lakh crores worth of futures and options
All
losses,
F&O.
which is a straight write-off. So a lot of effort has been done by SEBI, AMFI, various players to bring financial literacy, and that has succeeded to some extent. But at the same time, a large segment is still into gambling kind of activities. So that is the area of concern. The other, what you rightly pointed out, the vintage is very, very new. People haven't gone through a cycle. So people are probably coming with slightly elevated expectations, and they may lose confidence in case there's a longer sideways or a downward market. Already on a one-year basis, chatter has started. Oh, we should have just stuck with gold or silver or something like that.
In terms of a behavior, what is it that you're seeing? Because, you know, if you look at asset classes across the world, Bitcoin, F&O, it's very quick money, very high risk assets which have been doing well. Sure, you know, gold and passive investing as well may have worked. Is that telling you something about the nature of investment and the behavioral patterns per se?
So one thing, what has happened is participation has become very, very easy. So at a click of a button, you can buy and sell. Earlier, it used to take a longish period of time, and one had to really make that effort. Also, the gamification has happened, the nudging of people towards
add to cart.
Yes. And those fireworks go off if you make money and things like that. So that giving you that dopamine or instant rewards.
Instant gratification. Yeah.
So that has happened. The tenures on some of these contracts have been shortened, and there are two views out there. Should they be there, not be there? So some of the environmental factors have been such that it's given encouragement to short-termism.
And this entire, so just taking a cue from that, this entire, you know, the trend of de-dollarization, if I can call it that, do you believe that that is here to stay? Is it something that an investor should start to grapple with? Is it the entire play with regard to commodity hard assets getting priced much rather getting repriced very, very quickly as a result of this entire trend playing out? How do you view that, and how should an investor maneuver himself or his portfolio in this environment?
Sure. So do I see the international trade happening in something other than the US dollar? In the near term, no, because everything is priced in US dollar. It's a medium of exchange. Sure. Do I see it as a store of value for central banks? That has come under severe question marks. One is the persistent fiscal deficits run by the US government. Again, they are facing this shutdown issue because of the debt ceilings and things like that. And the move to seize Russian dollar assets in the wake of Russia-Ukraine war, that has sent a chill across central bankers. So what they are doing is they are shoring up on their precious metals and other reserves, and they are giving dollar somewhat of a backseat. So dollar may be used for on the go transaction, medium of transaction, but to store longer term reserves, I think central banks will look for alternatives, and they are already looking at alternatives.
So larger rally in gold, can we anticipate that?
More than this?
It's difficult to predict. So what happens for any commodity, not just gold, silver, is that reserves are there in the ground in terms of discovered mineable reserves. But at a particular price, a lot of the reserves remain uneconomical. So let us say gold at the price of 50,000 rupees, some mine may not be productive. But at 1 lakh or 1,50,000, it will start becoming economically viable. So supply will come in, it may take a while. So these things are challenging to predict in that sense.
I want to talk about your strategy at Parikh as well. And largely you've been focused on large caps, predominantly, if I can call it that. What's the way forward? Large caps are safer? Would you say it should be the flexi cap route? And is there any merit in India, which has been traditionally a stock picker's market, to even make that kind of, MCAP categorization?
So when we look at investing, our first thought is, what is the market cap of this company? Not to categorize it as small, large or mid, but if this is the amount I'm paying for this company, is there economic value in it? We don't care which category it fits into. How much weightage, will we get liquidity? All that comes later. We don't look at those questions while starting off. So sure, we may not look at 500 crore market cap companies anymore, but otherwise we are pretty much okay going anywhere. Recently we have bought a couple of small cap names. So in one case we picked up 9% of a company in a block deal. So we are looking across the spectrum. This whole narrative that it's almost like a law of physics that the smaller the company, the higher the returns, I think that is flawed in the Indian context. In some small cap names, valuations have become somewhat unsustainable. And market goes through cycles. If you look at the US markets, most of the returns have come from the largest 7 companies. It's not
7.
It's actually the reverse of what has happened in India. Again, the AMFI and the regulator are in conversations around the definitions of these market caps. So the top 100 companies are classified as large cap. That should it be changed? That discussion is going on. Should the mid cap space be expanded? Be as it is, today the way the regulations are, a company with 33,000 crore market cap is classified as small cap. So even in small cap, there are pretty large companies which we can invest in, and we do invest in that space as well.
And does the portfolio strategy change at all, given the size at which you are at now? Because you continue to compound at 22%, which is phenomenal. Will that number change in some manner? And of course, I know you're not in control of that number. I fully appreciate that. But just trying to get a sense, does the mindset, the methodology, are you willing to shave off a few basis points to ensure that the investing journey, the process continues? Is that at all on your mind? Because even the great Warren Buffett for the longest time compounded at higher rates, and now that rate has come off. So just trying to get your sense on how one should think of it.
The past returns will not be repeated, very, very unlikely. So not just for us, overall equity markets, I think people need to tone down their expectations. Stock prices are ultimately slaves of earnings. Earnings growth have not been coming in. Lot of people have had this optimism, oh, it's a cyclical slowdown in earning. Earnings will pick up somewhere down the road. What people are underestimating is the intensity of competition. So I don't hear too many people talking about this. in sector after sector, more and more people are coming in to compete away market share and profits, and they are willing to sacrifice margins. So in paints, you had 3 players, you have 6 players. In 10-minute grocery delivery, you have maybe potentially 5 to 10 players wanting to compete. Big box organized retailers, everyone wants to be there. There's one large jewelry company, now there are probably 5, 6 players wanting to compete in that. Be it gold loans, be it microfinance, each and every sector, every corporate house wants to have an NBFC, which is reminiscent of what happened in the 90s, where people just madly entered it. Very, very few sectors have seen people actually exiting the space and consolidation happening. This has happened in a handful of sectors, telecom or airlines or things like that, where there are fewer players. But otherwise, let's say there was one successful discount broker, now there are probably 10. So that becomes a challenge.
So you have a great pulse on valuations. Equity as well as debt, you've got a really good pulse. Give us a sense, where is the risk reward the most favorable at this point? Maybe from a 12-24-month perspective, how should one tilt their portfolio to try and maximize returns?
Actually, I'll tweak that question. From this Diwali to the next, an investor coming into the market right now for age 20, 30, 40 and then beyond, where should they invest?
So not just this Diwali, every Diwali that you ask me this question,
Flexi
I'll give you the same answer. For a 12-month horizon, equity is not the right product. So all money should go into fixed income for 12-month period.
Months, okay.
Because while longer term equities may have delivered historically maybe 15%, but year to year returns could be minus 50 as well. So in equities, you always have the risk of the next global financial crisis happening or the next COVID striking. So equity is an asset class only for minimum 5 years and maybe 7-year plus kind of horizons. Keeping that in mind, today we are in an environment which is lower inflation, lower interest rate environment. So while we are still growing, we are still among the fastest growing economies in the world, but our nominal GDP growth, our nominal corporate earnings will be far lower than what we saw 10 or 20 years back. So people have to calibrate their return downwards. So there was a time when something like a PPF would give you 12% per annum. AAA corporate bonds like Tata Steel and L&T were at 18% per annum. So when we are talking about equity returns, we are also including that era. So today when interest rates are 5, 6, 7%, equity returns will be barely double digits. And to get that, you have to withstand volatility. So only if you are prepared, one should come to the equity markets, and with a 5+ years horizon, I think they will deliver better than bonds.
And flexi cap funds?
Flexi cap funds are things that we like quite a bit, because what happens is when the end investor slices and dices the market cap, small cap, mid cap, large cap, each time they shift from one class to the other, they end up paying taxes. It's not efficient to compound wealth. In a flexi cap, the manager can invest where they are seeing opportunities. So that is a favorite category of ours.
Rajeev, great to have you then. And here's hoping that investors can stomach that volatility and stay put through what the market has in store for us.
Thank you so much. Wonderful being here. Very happy Diwali to everyone at ET Now and to all the viewers.
And to the Parag Parikh family as well.
Oh,
Thank
yes.
you so much. Thank you so much.